here after this massive acquisition and repatriation by the most well-informed traders on the planet. They doubled that amount in 2019, and out of nowhere, I'm sure there was no coincidence in this.
I think that in Q1, I think there are pretty good odds we're going to see silver back at $35. And I think anything from sort of Q2 onward, we could potentially, realistically, see something around 40 or north of 40. And I do think we'll have quite likely touched 40 at some point next year.
Please remember to support our channel by liking this video, subscribing, and turning on notifications to stay updated on content related to precious metals and economic analysis. Thank you, and enjoy the video.
You know, I had said that I expected $35 in Q4. We reached that earlier this quarter. I'm not surprised. It was quite the run-up. If you look at, I think back in February, we were at $22. So that's, I think, something like a 45% gain. It's really pretty tremendous within this calendar year. So I'm not surprised to see it pull back a little bit. I do think that somewhere around the 28, 29, 30-ish is a floor. I have also said that I think that, once we make it meaningfully above 30, that 30 would become a new floor. So far, it's looking like that's kind of how it's playing out. So I think that, the odds are a lot more favorable for the upside than for the downside at this point in silver. And, I was talking about a little bit earlier about, doing research, understanding the market and so on. And I think one really, really good example might be for people to look at what has happened in the uranium market, because that's been pretty fantastic actually for over the last few years. It's become quiet, but at a much, much, much higher level. And, if you are interested and you pay attention and you look at what's going on, uranium has legs for the next, I'm going to say, decade and beyond. And it's comparable in a lot of ways. So I like to quote a really, really interesting thing from a really very smart guy, a highly experienced, really seasoned guy by the name Leigh Garrett. He's with Gehring and Rosenzweig out of New York City. And Leigh Gehring actually managed one of the world's largest commodities funds several years back. And so this guy knows what he's talking about. And so here's what he said. He said, 5 years ago, we became uranium bulls because the market had quietly slipped into a structural deficit. And reactor demand had been outstripping mine supply. So what happened was fuel buyers used what we call so-called secondary inventories to fill the gap. So they didn't have to pressure miners to produce more uranium. They were able to tap into these secondary supplies, these above ground stockpiles of uranium, and drain those inventories. So Gehring saw this and he said, well, guess what? All these uranium miners have scaled back because prices had been so low for so long, about a decade. And production was, very minimal at that point. And there was no pressure on the uranium price because the consumers of uranium were able to go and as I say, drain these above ground secondary supplies. But what happened after that? So about 3 years ago, uranium was still at about $25, $27. Today we're at around 77. We've been above 80, and we've been meaningfully around 80 for months, if not a year at this point. So I'd like to draw some really, really interesting parallels with silver, because if you understand what I just explained about uranium and where uranium went and what happened with a lot of uranium stocks because of this triple in the uranium price, you haven't missed a boat, because you can look at silver right now and you have essentially the same setup. So over the last 4 years, just quickly, the silver market is about 1 billion ounces a year of supply. About 85% of that comes from mining and about 15% comes from recycling. However, demand for this year and over the last 4 years has been well beyond supply. This year to the tune of 20%. So we're consuming 1.2 billion ounces, and yet we're only producing 1 billion ounces. So, people have asked, and I've asked myself, well, in this kind of environment, how come silver is not $50 or $60 or something, much higher? And you really have the exact same thing as what happened in uranium. You have secondary supplies, so above ground stockpiles of silver. These are the identifiable stockpiles are actually sitting at the COMEX, the LBMA, the Shanghai futures exchanges, and in some silver ETFs. Beyond that, you do have difficult to quantify private hoards of silver. So if we put that aside for now, we do know at least we can look at and see what's happening with these measurable secondary supplies in these futures exchanges. And since early 2021, these exchanges have seen their supplies drop from anywhere around 40% to 70% in the last 3 to 3.5 years. It's kind of gone a little bit sideways over the last 4 or 5 months. But for 3 years, from early 21 till early 24, they've been dropping very, very, very steadily. So here's the parallel. The big consumers, I believe the big consumers of silver, in industry, electronics, solar panels is the biggest one now, have been able to tap into these above ground silver supplies and buy silver, buy it at spot price, not put pressure on producing more silver to meet this excess demand over supply and feed their need. And this supply is only going to last so long. When that runs out completely, then we're going to see silver just absolutely explode. And I think potentially do something like uranium did, which was to triple in a matter of a couple of years.
To today, where over the last 18 months, the central banks, the most well-funded and well-informed traders on the planet, have bought more than they ever have in history. And so they find it to be significant. But what opened up my eyes is an event that happened in 2019. And it really started opening my eyes in 2017. In all of the public speaking I was doing, I would talk about what started to happen in 2017. In 2017, we had witnessed 6 years of a downdrafting market where the price of gold and silver from its high at $1,915 in gold and just about $50 in silver in 2011. From that point forward, for the next 6 years, it drafted downwards. And by 2017, I wanted to hide under my desk or just not come into the office because for the first time in my career, everyone was selling. What was typically 1 out of 100 transactions was now 65% of everyone's business in this industry were people selling, aggravated that gold didn't live up to its reputation as a cut from the same cloth as Bitcoin soared to the heavens, and the stock market, having no gravitational pull, continued to move higher and people capitulated. Yet in 2017, something very interesting happened as all of this anti-gold rhetoric was fluttering around the ether. The German Bundesbank, who had tried for 3 years to get its gold back, made a very public disclosure demanding that the Fed send it back its gold. Now, this caught my attention. Why is the Bundesbank repatriating their gold when all central banks have been selling gold the last several years? And what really caught my eye is that within a few months of that happening, the Bank of Austria, Poland, Hungary, the Czech National Bank, the Dutch National Bank, all of these Eastern European banks did the same thing. They requested their gold back from the New York Fed and the Bank of England, and they made it fairly public. The following year in 2018, those same banks bought more gold as a group than they did in the 60 years previously combined. Now, I'm talking about this all over the place. It was 2019 when I started doing YouTubes, and it was because here, after this massive acquisition and repatriation by the most well-informed traders on the planet, they doubled that amount in 2019, and out of nowhere, I'm sure there was no coincidence in this, the Bank of International Settlements, which is the central bank, the most influential bank on the planet, reclassified gold as the world's only other tier 1 reserve asset, in essence. And so since the end of World War II, there's been one tier 1, US dollars and treasuries. Gold was always a tier 3 asset. where only 50% was calculated on the balance sheet, which would denigrate your balance sheet, would inhibit the ability to do things with a full balance sheet. Here, only 50% was calculated on the balance sheet. And so central bankers, they didn't want to own it. It was denigrating their balance sheet. It cost money to store. It earned no interest. So they would sell it in favor of treasuries or in favor of equities or whatever was doing better. And all of a sudden, now it's a tier one. And the banks had been buying it for the last 2.5 years before this and repatriating it. Now something's going on. And so there's only one other tier one asset, according to the most influential traders on the planet, other than US dollars and treasuries, and that is gold. And when you look at gold that has been acquired by the banks pretty much nonstop since 2017, there's no coincidence to me that last year or the last 15 months, they've bought more than at any time in history. This to me is the underlining why, is that gold is wealth, gold is money, and gold is viewed that way by the most influential players on the planet. They use the Western suppression of COMEX in order to run cover for their acquisition. If I want to buy a COMEX contract, which was 100 ounces, to hedge my position in my warehouse, I only need $7,000 or thereabouts in my margin account, and I control nearly 200,000 worth of gold. If I am a commercial bank or a central bank with 500 million in my margin account, I control 15 billion worth of gold on COMEX. I can create any perception of reality I want. And that is exactly what has happened for a very long time. There's a term in economics called Gibson's paradox, which speaks to the inverse relationship between real interest rates, which have been horrible, and the price of gold. And if you are going to maintain super low manipulated interest rates to create a perception or an illusion of prosperity like we did for so long, then you have to step on the canary in the mine shaft, and that was the price of gold. And yet all of a sudden, the most influential, well-funded banks on the planet are not only buying it at levels we had never seen before, but they were repatriating it from the exchanges and the Western central banks. So to me, on a very, very, very basic level, that's why people need to own it, because the most influential, well-funded, well-informed traders on the globe say one thing and are doing the other and accumulating it as if it is really important. So on a very generic, basic level, the biggest money in the world says you should own it by their actions, less by their words, and they're using manipulated price to run cover for their de-dollarization and their acquisition. That's why you need to own it. Look, the paper market still is the tail wagging the dog, no question about it. But I could argue it's losing its ability to continue to do this at a rapid pace. The London Metals Exchange is a good example. They have pretty darn close to the lowest amount of silver in the exchange that they've had in the 140-year history of the exchange. We've seen a massive bleed down in gold and silver off the COMEX market, where in 2020, this group of they're called the others on the COMEX. They came out of nowhere in 2020. There used to only be two groups of reportables on what they call the Commitment of Traders report. Every week, the exchange publishes the positioning of the largest traders, and it was always just the commercial banks and the specs, which would be the hedge funds. That's it. And then out of nowhere in 2020, they published a new group of reportables they call the others. I believe they are sovereign wealth funds and very well-to-do family offices who are draining the exchanges along with the central banks, to the point where in 1 year in 2020, we saw more silver delivered than in a decade before combined. They took more gold off in 2020 than the Bank of Japan has in their official holdings. And these trends, both in what's called exchange for physical, where you can buy a COMEX contract and exchange it for physical in London, and or the bleeding down of the COMEX, is to the point where you're at the second lowest level of silver in the registered category in the history of the COMEX, and massive bleed downs in gold in a market that was never designed to be a delivery mechanism. This is why it's getting harder to suppress the price, because when the price gets suppressed, you have sovereign nations and sovereign wealth funds that are standing there like, okay, we'll take delivery. And so the delivery, or the prospect of massive delivery off of the exchanges in an environment where the availability of metal is decreasing on these exchanges, means we're getting closer and closer and closer to that moment. Look, it's easy for these players to manipulate a market by pushing it in the direction that it is going. When nobody wanted gold and silver, it was easy to suppress the price of gold. Now it becomes a very dangerous game.